McDonald's stock is the topic of today's presentation, and if you're somebody who's invested in MCD stock, then you'll want to watch this because we talk about what the business actually does, which isn't so intuitive on the tin. So as we call it here in the States, Mickey D's. This is the country where Mickey D's has the largest number of restaurants, and it shows in this first metric 1 in 8 Americans have worked at a McDonald's restaurant. So that was actually taken from McDonald's. And some of these other factoids, it's hard to distinguish the source, whether they're urban myths or actual truths. Largest private operator of playgrounds in the United States. It's said that McDonald's is also the largest toy distributor, the largest purchaser of potatoes, apples, beef, and pork. And of the 40,275 McDonald's restaurants at this year-end 2022, this metric, approximately 95% were franchised. That's also a little bit non-intuitive when you look at their numbers. But this last bullet point here is probably the most important. Is McDonald's an international real estate company? I remember in B school that this was a classic case study when we were asked, what does McDonald's actually do? And to a certain extent, yes, they are. So as of the end of last year, McDonald's owned approximately 57% of the land and 80% of the buildings for restaurants in its consolidated market. So all those 40,000 restaurants, that those statistics apply to that. It earns approximately 60% of its operating income outside the United States, which adds that international element. And here, this is taken from their latest 10K, as all the tables are in this presentation. But here you can see that of the revenues that come from franchise restaurants, a majority of those are rent, and you can see that 61% of their total revenues, and the total revenue number isn't here, but we did the math, come from McDonald's being a landlord at some of the best real estate locations in the world. And you look at where, for example, Hong Kong is one of the most expensive places for real estate in the world, and McDonald's occupies some of the best prime real estate in Hong Kong. And the reason that we're covering McDonald's is because we've recently released our Nanalyze New Money portfolio, and this was to address questions we get from new subscribers asking about which stocks we find most compelling. So we put together a portfolio of 10 tech stocks and 10 dividend growth stocks, and as you can see here, McDonald's happens to be one of them. Now, for those of you that enjoy our videos, and plenty of you do based on the comments that we receive, we need your help to support this channel. We don't run ads, which means we either need to grow this a whole lot faster or we need the financial support. And a lot of channels out there will run Patreon or ads to support themselves. We don't use Patreon because they limit what you're able to say, and they can classify anything that you say as hate speech and freeze your account. So we've built our own platform, and you can see here, just by subscribing to a free plan, what you don't see is we produce a lot of research pieces. This says 2,000. I think we've had well over 2,300 research pieces now. You can receive up to 4 new premium articles every month, that should say, not week, and gain access to our standard newsletter. Just go to our website, click subscription plans, and sign up for a free plan, or better yet, an annual subscription or monthly subscription to support our work. We'll actually be debuting a coupon soon for YouTube viewers only. Now, let's get back to talking about McDonald's. So here's a very interesting table at the top that is somewhat misleading, and I'm going to explain these numbers so that you understand it the way that I was able to after spending some time looking at it. So you see the revenue breakdown on top, sales by company-operated restaurants of $8.7 billion, and then revenues, not sales, revenues from franchise restaurants of $14 billion. Very different there, the statement, sales, food sales from company-operated restaurants versus revenues they're receiving from franchise restaurants. As we saw in that previous table, it was what? Royalties and rent. So those are revenues, and then the sales also are counted as revenues, but you need to distinguish between the two, and you get a total number of $23 billion in revenues. So when you look at this and you see, well, 38% of revenues come from company-operated restaurants, 62% from franchise restaurants. What about that whole number they said about 95% of the restaurants being franchised. Well, that is true. So when we look at the total number of restaurants they have, remember we said upwards of 40,000, only 2,000 of those are company operated. So there's an implication here that they get a ton more. They don't get, the franchised restaurants get a ton more revenue than what you're seeing here, which is indeed true. But for McDonald's, what you want to pay more attention to is where the profitability comes from. So here you can see the below table. You've got your revenues. Okay, then you have your margins. So look at franchised margins. So 90% of the profitability that McDonald's realizes comes from franchised restaurants. So here you can see franchised sales. So this does not reflect revenues for McDonald's. We already saw McDonald's has $23 billion in revenues in 2022. But look at how much sales are coming from their franchised, what they call franchise sales. They're franchised restaurants. They break down in the bottom table here the types of franchises. We're not going to get into that. But what we're predominantly interested in here looking at is their exposure to the U.S., and about 60% of McDonald's exposure is international, and that's great to see, right? But this bottom metric, very key, 93% of food sales for McDonald's come from franchise restaurants. Those sales numbers are not reflected in McDonald's revenues. So now that we understand that, metrics that we should pay attention to going forward, for example, comparable sales. So this is commonly used in, I suppose, companies across all industries use this metric, and it just looks at it's probably best stated here. Comparable sales are driven by changes in guest counts and average check. So all your restaurants that you have, how did they perform year on year? And it says the latter of which, so average check size, is affected by changes in pricing and product mix. So, this is the old classic economics problem. If you lower the prices, you get more customers, but then perhaps you get less money. You want to make sure that there's an optimal pricing for the number of customers that you receive, because that also reflects, you can only get so many customers into a restaurant. So here, these numbers, you can see 2020 reeling from the Rona, and they had decreased sales in international operated markets and their other category there. And in the U.S., they saw barely any growth. And then you could see the following year, 2021, growth resumes. And then this year, or let's say last year, some pretty decent growth for the business. Now, one place that they didn't grow is in Russia. So there's this old saying, and it's that no two countries that both have a McDonald's have ever fought a war against each other. And it's mostly true, and that comes down to what the definition of a war is. I think we can all agree that Ukraine and Russia are currently at war. And you might say, well, Russia has McDonald's. Well, not anymore. So the new McDonald's, McDonald's has moved out, and all those stores are now named Вкусно и точка. And that means tasty and that's it. And there's somewhere around 850 stores that now offer branded items that don't include Big Mac or McFlurry, some of the big billion-dollar brands that McDonald's has. And what this points out is that there are some geopolitical risks that exist here, and a country breakdown of McDonald's stores or restaurants would be very useful. Here you can see that. So I think this is somewhere off Wikipedia or something. Let's say it's mostly accurate. And of course, in the United States, they have the most restaurants, in China, then Japan. But look at Russia's not doing too bad there, but now they're gone. So the other metric that you want to look at here, and this came up, I think, 3 or 4 years ago when we were putting together our Quantigence report, which is our dividend growth investing strategy. We wanted to know how much upside is there for McDonald's in terms of future growth. Well, look at the column here on the right. Number of restaurants per million population. So you have 40 restaurants per million people in the United States. And then look down the list there at Canada, 39. Okay, so in North America, where McDonald's sees the most penetration, that's about maximum saturation. So then we can say, all right, for other developed markets, we ought to see similar saturation. Look at Australia, 39, right? UK, 21. Okay, UK could see more more potential McDonald's than they currently have. But what's more interesting is when you start to look at countries where they hardly have any representation. And look at here, the number of McDonald's restaurants, for example, in Indonesia. This is the actual number. This is data, I think, from 2016, 2017, it might have changed. Kenya, 0. These are large population centers, and this chart shows the population sizes of these places where they might be able to expand their brand. So there's a lot of future expansion possibilities for McDonald's, and as when it comes to growing their revenues, as a business, they have a lot of opportunity. What we want to look at always as investors are the risks, and perhaps the most obvious risk with McDonald's, the one that seems to be most discussed, would be their high levels of debt and the rating for that debt. So it's rated at, as you can see here, these are bond ratings for Moody's and Standard & Poor. The grade's investment just above junk there at medium risk. So there's some concern there, but the other argument is that McDonald's raised a lot of debt when it was smart to do that, when debt was cheap. And you look at these numbers in their 10K, pay close attention to these, right? And they don't change much from year to year. 96% of their debt is fixed rate at an average rate of 3.5%. So that's pretty cheap debt. And then this last metric, just to put it into context, cash provided by their operations as a percent of total debt, 20%. So the idea there would be, it would take 5 years to pay off their debt if they just used the cash in their operations to pay down debt. And of course, they don't do that. And what we want to look at then for McDonald's, since we're dividend growth investors, we're very interested in the likelihood that they can continue growing dividends over the years. They've grown their dividend for 47 years in a row. That's a remarkable track record. So this chart taken from the 10K is interesting. Looks like they're repurchasing shares, and one could be quite critical of the company doing that right now. And they say that, purchasing shares, of course, increases earnings per share, which helps benefit their executives who are compensated related to that metric. And I haven't dug into that to say whether it's true or not, but McDonald's shares have certainly enjoyed a lot of price appreciation, and they wouldn't be considered depressed at all. So the fact that they spent a whole bunch of money here, so look at where we've highlighted there. Let's forget about cash provided by operations for a second and just look at what they spent. So money returned to shareholders here. Treasury stock purchases, so they spent, $3.9 billion repurchasing shares. You could see at the top of that table, 15.8 million shares compared to the previous years. You could see how many shares they purchased in 2022, plus dividends paid, so roughly $4.17 billion in dividends paid. The total return to shareholders was $8 billion. So when we look at dividend growth and dividends being paid, we're most concerned with them being able to continue increasing dividends over time. So remember the metrics, the simple metrics we use when we look at companies in the tech arena. Cash provided by operations, we want to see that as positive because it means a business doesn't need to dig into its cash stockpile to keep the business running. And if you're running a negative cash provided by operations, that means that you need to keep raising capital. It's not a good environment to do that. So certainly these numbers are from 2022, $7.4 billion, and that's a 19% decrease from the prior year. So you want to pay attention to things like that. But remember, we talked about how then when you have cash provided by operations, you take capital expenditures and subtract that, and then you get free cash flow. And this is really simple. So they had their operations generated $7.4 billion. They took 1.9 of that and allocated half to reinvesting in existing restaurants and half to new restaurant openings. Okay. That left them with free cash flow of $5.5 billion. Now, it's a 23% decrease in the prior year, and that's noted, but that free cash flow of $5.5 billion, then look at their dividends paid for. They could easily cover those dividends paid, right? So that's what we want to pay attention to. And we look at the growth of their dividend. I pulled this from Schwab. As I said, 47 consecutive years, but you can see these growth numbers. And from 2022 to 2023, they raised that dividend by 10%. So they continue growing that, and hopefully will continue doing that for decades to come. Wanted to touch quickly on price versus yield. And this bottom chart here, this is their yield plotted over time. I always love these charts because this is a low beta stock, 0.64, which means that it doesn't experience a lot of volatility, and that's very evident in this bottom chart that shows you. People say things like, well, I'm waiting for McDonald's yield to go above 3%. Well, you've been waiting a while, because it looks like maybe in, about 2017 until now, that yield's been under 3%. You can see there around 2016, it was just around 3%. And of course, see the spike there I've highlighted, which, that looks around 2009, perhaps, when there was that crisis that we saw in the market. So when the share price dips a lot, yield goes up, right? And look at the top chart there. Look at how stock price has just been steadily going up. Again, low beta stock. Now, this is quite important for those of you thinking about, well, now probably isn't the right time to buy McDonald's. And I want you to look at this chart on the right. And of course, the shares are close to an all-time high. And that red line, that's our cost basis for McDonald's. So it's about $108 a share. And I can remember, and we purchased McDonald's for a long period of time. We were dollar cost averaging into our Quantigens portfolio, which has 30 dividend growth stocks. One of them is McDonald's. I can remember back then researching very heavily McDonald's as a business, because there was so much banter in the marketplace about how McDonald's was done. All these great, Smash Burger, California Burger, all these fast food outfits in the U.S. that had, great quality food. They're saying McDonald's is toast. They'll never be able to compete. The days of fast junk food are gone. Absolutely not true. Travel all over this world, I rarely see a McDonald's that isn't packed. McDonald's sells, and guess what? When there's a recession, they sell even more cheap food. We only sell McDonald's stock if dividend growth stops. That's the only reason that we would ever sell this firm. At the moment that they stop increasing their dividend, we're out. The best approach perhaps to take, based on my personal experience in investing in dividend growth companies, dollar cost average into quality companies at any given time. Don't try to time the markets. If you want to time, just adjust the amounts you're purchasing per month, okay? So you think McDonald's is overpriced, and maybe you're not buying that much of an equal weight. But right now, one could argue, perhaps could be the perfect time to start buying, because if shares start sliding, that's when you want to be buying, right? So I've always found that the way that's helped me sleep well at night, the easiest way is to have a nice portfolio of dividend growth stocks and buy a little bit every month. And if one starts getting too far ahead of the others, then you can just reduce the amount that you're putting in and contribute that to others that perhaps are sliding, right? And that way, when you can adjust the amounts that you're contributing every month, it sort of balances your weightings out. So to conclude, people are always going to need cheap food. This photo is a call out to McDonald's when they used to sell hot dogs at one point and then decided that wasn't the way forward. The company has some great international diversification, and not only in terms of geography, but also in what they do, the real estate information that we looked at in this presentation. There's some concerns, of course, surrounding debt and share buybacks. There will always be concerns for a company like McDonald's that gets a lot of attention. And I think the beauty of our strategy, our Quantigens dividend growth strategy, is that we only focus on a single metric, that is dividend growth. That's the only reason that we'd ever sell. So I've put up another video here that you might enjoy watching. Before you watch that, please click this Nanalyze logo on the right. Subscribe to our channel. Support us. We don't run ads. We need your help. Thanks so much for taking the time to watch this today.